Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Momentus.
If you find our talks useful, please hit subscribe and leave us a comment below. That's the best way to support the show. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For about the last year, Momentus has been a classic example of this. This huge infrastructure dream just colliding violently with a brutal financial reality.
Right.
When you look at this stock, you are not buying a traditional growth company. You're buying a complex, really a binary bet on the future of in-space logistics.
That framing is so crucial.
Yeah.
Because when people hear space company, I think they just picture rockets blasting off the pad.
Yeah, the big launch.
But Momentus it's different. They are the specialist, the company that takes over after the initial launch is already done. What is their specific niche and, why does it matter so much?
Well, it matters because it's their competitive moat. It's their entire reason for being. Think of them as the high-tech, space-based U-Haul.
Okay, I like that.
They're not focused on building the highway. That's for the launch behemoths. Momentus provides in-space transportation and orbital services. They use proprietary propulsion technology to deploy, maneuver, and service satellites after they're already up there.
So if a major company launches, say, 5 satellites on one big rocket, Momentus is the one that steps in to shuttle those 5 to their precise final orbits.
Exactly.
It's that precision logistics layer that the big launch companies, frankly, don't want to bother with.
It's the complex last mile. And this allows them to carve out a necessary slice of the whole ecosystem. But, and this is the huge but, building and testing this kind of technology in space requires a staggering amount of capital.
Which brings us directly to the financial reality check.
Yes, it does.
And what a reality check it is. I mean, where do we even start with what this company is generating right now? We really have to look at the books with a microscope.
The financials are stark, let's put it that way. When we look at their trailing 12-month revenue, their PTM, it stands at a tiny $3.08 million.
$3 million. For a public space company.
In that context, that number is almost negligible. It's a rounding error for most companies.
And it's not just small, it's shrinking. Our analysis showed it's actually down nearly 30% quarter over quarter. When you're building multi-million-dollar vehicles, that level of revenue, it can't possibly be covering your costs.
It can't. And the margins really show that burn rate. This is where the numbers get, well, they get shocking, but also entirely predictable for a company in this phase.
Lay it on us.
Their operating margin is a deeply negative 576.0%.
Wait, say that again? Negative 576%.
That's right. And their return on equity is a staggering negative 813.6%.
Just to put that in perspective for everyone listening, when an operating margin is negative 576%, what does that fundamentally mean about their day-to-day?
It means that for every single dollar they bring in through the door, they are spending almost $6 just to keep the lights on and develop the technology. All the capital they raise is just immediately consumed by development, by engineers, by testing, by building out their orbital service vehicle fleet. This is why their market cap is only $10.5 million.
So the market sees them as basically a pre-revenue R&D lab, even though they technically have some sales.
Exactly, despite having contracts.
Okay, so the microscope view shows a company that is just bleeding cash with shrinking revenue. It sounds completely unsustainable. Why is anyone even looking at the stock?
And that brings us to the telescope view.
The like line.
That's the entire investment thesis. The market is ignoring the current $3 million in revenue and is focused entirely on the secured potential future work. These contract wins are the lifeblood. They validate that the tech is actually needed.
Okay, let's break those wins down because they really do tell a powerful story of validation against that bleak financial backdrop.
They absolutely do. The biggest recent one is a huge deal with Solstar Space for in-orbit services. It's a $15 million deal.
$15 million. Just to be clear, that one contract is 5 times their entire revenue from the last year.
Correct. It completely changes the potential revenue trajectory overnight.
And it's not just commercial customers, right? They've got bigger names involved.
Right. They also secured 2 crucial contracts with NASA, totaling about $7.6 million.
No.
And when you have an institution like NASA signing on, that's not just cash.
It's credibility.
It's the highest level of technical due diligence you can get. It says the technology is viable.
And then there's the SpaceX deal.
Yes. They secured a SpaceX launch contract for 2026. This isn't just them buying a ticket for a ride, it cements their role. If a primary launch provider is integrating your vehicles into their schedule,
Then you're a legitimate, necessary player in the supply chain.
you're part of the ecosystem.
But, okay, securing contracts is one thing. Executing them requires capital. We just established they're burning cash at an insane rate. How did they bridge that funding gap to make sure they can actually deliver in 2026?
That required some pretty significant financial maneuvering. This is a key catalyst we identified. Through recent warrant exercises and inducement agreements, they secured gross proceeds between $3.7 and $7 million.
Okay, that's the working capital they need.
It keeps the engineering teams funded and the development pipeline moving.
Let's pause on that point, because warrant exercises is heavy jargon. In simple terms, what does that mean for the company and for the existing shareholder?
A warrant gives someone the right to buy stock at a set price in the future. So when they're exercised, the company gets an immediate injection of cash, the working capital they desperately need.
But there's a catch.
There's always a catch. Those new shares increase the total number of shares out there, which means every existing shareholder now owns a slightly smaller piece of the pie. It's dilution.
A necessary trade-off, then. Dilution for survival.
Exactly.
So you have this immense good news of validated contracts, and then the immediate bad news of continuous funding through dilution. Which brings us to the technical picture, which has been just chaotic.
Chaotic is the perfect word. The stock has been utterly crushed.
I mean, we've seen a decline of nearly 97% over the last year.
And even just in the last month, it dropped almost 59%. The market has delivered maximum punishment, reflecting both the poor financials and these painful corporate moves.
But this is where the analysis flips, right? Because when selling pressure is that intense, the technicals often signal that the punishment is just unsustainable.
That's right. We're looking at indicators showing extreme oversold conditions. The stochastic oscillator, for example, is sitting at alarmingly low levels, around 4.17.
When you see a number like that, what is it telling you?
It's like a rubber band being stretched to its absolute limit. It signals that the supply of sellers willing to dump the stock at these prices has nearly dried up. A sharp technical bounce becomes statistically overdue.
And with the stock trading around, what, $4.87? This oversold territory, combined with the insane volatility over 113%, it suggests the stock might be finding a floor, a base for a speculative entry.
And that speculation gets amplified when you look at the long-term outlook. We've seen some algorithmic forecasts based on them actually executing these contracts.
And they are projecting some massive breakouts.
Massive. I'm talking about models suggesting an average target of $138.22 by 2026.
Whoa, hang on. Let me stop you there. $138. We just established this is a company with a $10 million market cap. Hitting that target would be a gain of over 2,700%. Isn't that just bordering on fantasy?
It is absolutely speculative, there is no doubt. But it reflects the binary nature of this sector. In space tech, if you prove your proprietary tech works and you successfully deliver on high-value contracts, especially with NASA and SpaceX in your corner, the valuation can shift almost overnight.
From an R&D metric to an infrastructure valuation.
Exactly. That $138 target is based entirely on the assumption of flawless execution. It's the grand prize if this binary bet pays off.
That helps frame the risk. But let's go back to the immediate pain, because that selling pressure wasn't just about financials. It was driven by some non-operational news. What was the bear case really focused on?
The primary pressure point was corporate compliance. Specifically, avoiding getting delisted from the NASDAQ. Their stock price had fallen below the required minimum.
So to fix that, they had to do a reverse stock split.
A 1-for-17.85 reverse split, which became effective late last year.
Reverse splits are a necessary evil sometimes, but they often terrify investors. Can you just quickly explain what a 1-for-17.85 split actually does?
It just artificially inflates the share price by condensing the number of shares. So if you own, say, about 18 shares before, you now own one share that's priced 18 times higher.
The total value of the company is the same, but the share count plummets.
Right, down to roughly 1.4 million shares. And the market hates it because it's a signal of deep distress. It shows the company couldn't keep its price up on its own merits.
And the reaction was immediate. The stock plunged over 47% right after the announcement. That's a brutal hit for a procedural move.
It is, but it also creates the condition for extreme volatility going forward. With a tiny share count, what they call a low float, Any major positive news could cause a much faster, sharper rise,
It makes the stock highly susceptible to swings.
which is exactly what a high-risk speculator is looking for.
Okay, so we have the compliance issue being solved, painful as it was. We have the dilution being accepted to fund the R&D. If those two big risks are now largely priced in, what is the single biggest risk going forward?
It boils down entirely to one word: execution.
Simple as that.
Can they successfully deliver on these high-value, very complex, secured contracts? Moving from testing to reliable commercial service is incredibly difficult. If they miss milestones or, God forbid, fail that 2026 test flight, all that speculative valuation just vanishes.
Yeah.
Instantly.
So the focus shifts entirely from financial tricks to operational success.
100%.
So let's talk about the timeline. What should our listeners, who might be considering this bet, be watching on the catalyst calendar for the next 12 to 24 months?
Well, first we have to acknowledge the macro tailwinds. The whole commercial space infrastructure sector is booming. That's a favorable backdrop. And, potential future rate cuts also really help these speculative high-growth names.
Right, makes their future earnings more valuable. But besides the big macro picture, what are the specific company events to track?
First, you have to monitor the post-split trading. We need to see stability in this new share structure. Second, we have to track any milestones related to development for that 2026 SpaceX launch window. That launch itself will be the key visibility driver. It's the primary catalyst.
So if we summarize the investment timeframe, this is not a short-term trade based on earnings. It's really more of a swing trade opportunity, riding the anticipation into those first major contract milestones in, say, early 2026.
That's the minimal time frame. For someone who is truly aiming for that massive speculative target, that $138, they need to be committed to a longer hold, probably 12 to 24 months, and it is entirely contingent on seeing those R&D costs finally translate into real delivered revenue.
It's a marathon where the first mile is the most dangerous.
Well said.
Momentus really presents one of the clearest examples we've analyzed of immense future potential colliding head-on with a current financial struggle. The contracts they've secured are a vital lifeline. They provide validation for major players, but the journey requires almost flawless execution to bridge that enormous gap between its tiny $10 million market cap today and those speculative targets north of $138.
It's a huge gap to cross.
For you, the listener, the knowledge gained today tells you that this is not a bet on today's revenue. It's a bet on their ability to execute in 2026.
If you want to keep up with the execution risks and rewards in this volatile space sector, make sure to hit that subscribe button to stay informed on tomorrow's analysis.